Welcome to today's Explainer. We've got a really fascinating financial detective story to unpack today surrounding Supermicro Computer Inc., or as you probably know it by its ticker, SMCI. If you've been pulling your hair out trying to find any actual value left in this overheated tech market, well, this is a story you absolutely need to hear. You know, in the investing world, finding a true market inefficiency is kind of like finding a needle in a haystack. But today we're looking at a company that is sitting smack in the middle of the global AI boom, and yet the market seems to be pricing it as if it missed the boat entirely. So we're going to dig into exactly why that is and what it could mean for anyone keeping an eye on the infrastructure space.
Okay, take a look at this incredibly rare number on the screen, a 0.11 PEG ratio. For those of you who track valuations, you know the PEG ratio measures a stock's price to earnings relative to its actual growth rate. It basically answers the question, am I overpaying for this growth? Usually a PEG of 1.0 means it's fairly valued, and anything under 1.0 is considered a discount. So seeing a 0.11 PEG, that's literally off the charts. It typically signals extreme, almost absurd undervaluation, especially for a stock that is experiencing massive compounding growth. When you see a number like this out in the wild, you have to stop and pay attention, because it means the market is either completely mispricing the asset, or it knows something deeply terrifying that just isn't showing up in the current earnings.
And really, that creates this massive knowledge gap, leading us right to the central question we're going to solve today. How on earth can a company with over 100% revenue growth be trading at such an unbelievable bargain? It's a total paradox, right? You almost never see hypergrowth in deep value metrics in the exact same asset, especially in the tech sector, where everyone is fighting tooth and nail for the next big AI winner. We really need to unpack what's driving this massive disconnect.
Here is a quick look at our roadmap for the Explainer today. First, the AI valuation mystery. Second, SMCI's competitive advantage. Third, the liquid cooling revolution. Fourth, peers and financials. And finally, price targets and risks.
All right, let's kick things off with Section 1, the AI valuation mystery.
Just look at these numbers. We've got a company trading at roughly $39 a share. They are putting up explosive 94% earnings per share growth, and their top-line revenue is growing at over 100%. But then you look down, and the stock is sitting at a remarkably low 12 times PE multiple. To put that into perspective for a second, a 12 PE is what you'd happily pay for a sleepy, slow-growing utility company or maybe a legacy brick-and-mortar retailer. You certainly don't expect it from an AI infrastructure giant. For anyone trying to make sense of tech valuations, seeing these two realities exist at the exact same time is what makes SMCI such an amazing and frankly confusing case study.
Let's move right along to Section 2 and figure out how they do it. SMCI's unfair competitive advantage.
As this table perfectly illustrates, when it comes to time to market, SMCI's absolute superpower is speed. Literally, when a new chip comes out, SMCI is designing, testing, and fully deploying custom servers in just 2 to 3 months. Now compare that to the industry standard of legacy giants like Dell, taking 6 to 9 months, or HPE, taking up to 12 months. In the AI arms race, a multi-month head start isn't just an advantage, it's a lifetime. It means SMCI's clients can start training their models and actually generating revenue quarters ahead of the competition.
So what's the secret sauce behind that crazy speed? It's something called building block architecture. Basically, instead of engineering every single custom server from scratch, SMCI uses a modular, Lego-like system for their data centers. Because they have an inventory of over 5,000 different SKUs, they can just snap together these incredibly customized, highly specialized server racks way faster than anyone else in the industry. For investors, the takeaway here is huge. It means they can capture revenue from emerging AI trends months before their competitors even have a product out the door. It's a genuine structural moat that is just incredibly difficult for the bigger, more bureaucratic competitors to replicate.
Which brings us to Section 3, looking at the tech driving their future, the liquid cooling revolution.
Here's the deal. The latest generation of AI chips, like Nvidia's massive GB200, run hot. Like incredibly hot. Traditional air cooling just doesn't cut it anymore. Data centers would literally melt down under the thermal load of these new architectures. And right now, SMCI is the exclusive liquid-cooled rack partner for Nvidia's highly anticipated Blackwell platform. Let that sink in. Being Nvidia's go-to partner for their absolute most advanced power-hungry hardware puts SMCI at the bleeding edge of the industry. They aren't just tagging along for the AI boom, they are literally building the physical infrastructure that makes the next generation of AI possible. And the result of that elite partnership?
Take a look at this chart. It is absolutely staggering. SMCI has an overwhelming 90+% dominance in the direct liquid cooling or DLC market. The rest of the market combined is left fighting over scraps of less than 10%. SMCI basically owns a sector that is projected to explode from $2 billion in 2024 up to $15 billion by 2027. When you are trying to evaluate the long-term viability of a hardware company having a near monopoly on the exact cooling tech that the entire industry is forced to transition toward, that is an incredible catalyst for sustained growth.
All right, let's put this into context. Section 4, Peer Comparison and Financials.
This contrast right here really highlights the main thesis of our explainer. The stock market is basically suffering from a massive identity crisis when it comes to SMCI. Think about it. The market is pricing them exactly like a legacy server assembler, lumping them in with Dell and HPE at those lower 11 to 16 times PE multiples. But operationally, their growth profile mirrors the absolute best AI chip designers, like Nvidia and AMD, who are seeing explosive triple-digit growth. It's like the market just hasn't figured out what kind of company SMCI actually is yet.
When you see these multiples side by side visually, the gap is glaring. SMCI sits way down there, just 12 times earnings, compared to the towering 40 and 45 times multiples of AI peers like AMD and Nvidia. We're talking about a 65 to 75% valuation discount compared to the very same companies that are driving SMCI's own revenue growth. For anyone looking to build a portfolio, this represents a really unique arbitrage opportunity between a company's actual, boots-on-the-ground operational performance and the market's somewhat outdated perception of its business model.
And aside from just being cheap relative to its peers, the underlying internals of the business are totally pristine. A perfect example is this outstanding 35% return on equity. What that means is, for every dollar of equity the company holds, it is generating 35 cents of pure profit. They aren't just moving a ton of servers. They are highly efficient capital allocators undergoing a massive free cash flow inflection. And that inflection point is absolutely crucial because it means they are finally transitioning from burning cash to build out their infrastructure to throwing off massive amounts of cash that can be used for share buybacks or reinvesting back into the business.
Let's wrap up our investigation with Section 5, Price Targets and Risks. We obviously have to look objectively at the real risks here. The biggest threat, which is assigned a 30% probability in the source analysis, is increased competition from heavyweights like Dell and HPE as they inevitably try to catch up in the liquid cooling space. There's also a 25% probability of a broader AI capital expenditure slowdown across the tech sector. And crucially, there is a 15% probability regarding accounting or restatement risks, which, let's be real, is an issue that has heavily contributed to the stock's current massive discount. Understanding these probabilities is just essential before making any kind of financial decision.
Now, regarding that specific 15% accounting risk, the source notes several structural mitigants that we need to factor in. SMCI has engaged a major new auditor, BDO. They remain current with their SEC filings, and an independent review has already been completed. These steps basically provide a structural safety net against the absolute worst-case accounting fears that the market has arguably overpriced into the stock right now. It's a great reminder that scary headlines often drive short-term panic, while actual structural audits reveal the long-term reality.
So, tying it all together, when you model out the actual valuation scenarios, it reveals a pretty fascinating risk-to-reward setup. Even in the absolute bear case, the downside is modeled at roughly minus 15 to 25%. But look at the base case on the screen, modeling a price somewhere between $72 and $81. That represents over 100% upside from current levels. And when you probability weight all these different scenarios together, the expected value sits at roughly $82 a share. It gives us a really clear quantitative framework to evaluate the opportunity here.
And that leaves us with this final, highly provocative thought to ponder. We've got a company with 90% market share in the most critical new cooling tech. They're partnered exclusively with Nvidia. They're growing revenues at over 100%, and yet they are trading at a 12 PE. So, does the market eventually wake up and correct this massive inefficiency, or will SMCI remain AI's hidden undervalued giant permanently trapped by market perception? It is definitely going to be a fascinating situation to watch unfold. Thanks so much for joining me on this explainer, and as always, keep your eyes on the data.
All information provided is for educational purposes only. Always consult with a qualified financial advisor before making any investment decisions.
Thank you for watching. Please like and subscribe to our channel.